which is open to both the press and the public on request. As ever, this meeting will not be broadcast live. However, a recording will be made available as soon as possible after the meeting has concluded. We welcome the use of the Welsh language at meetings. I've received no requests for anyone to speak Welsh today, however, so this meeting will be conducted in English only. May I remind members that as per statutory guidance made under Section 4 of the Local Government Wales Measure of 2011 and our formally adopted hybrid meeting policy, any member attending a meeting remotely must be able to be seen and heard by the members and officers who are attending the meeting, as well as by members of the public viewing the meeting. So can I ask, John, and I can already see your smiling face, that's fine. Can you please keep your camera on for the duration of the meeting? Please can members attending via Teams refrain from using the chat function and instead use the raised hand icon to indicate when you want to speak. So again, John, that's just you. Please remember as well to keep your microphones muted when you're not talking. Right, the pleasantries are done and dusted. We'll move on to the agenda. Item number 1, we have attendance and apologies. Jade.
Thanks, Chair. We haven't had any apologies for today's meeting.
Okay, thank you. I've got apologies for lateness from Councillor Alfie Best. He's going to be 10 or 15 minutes away. Anybody else? No? Great stuff. Thank you very much. Agenda item number 2, declarations of interest.
Thanks, Chair. So, Councillor Gordon, I have that yourself, your wife, your stepdaughter and your stepdaughter partners is contributors to the fund. And I also have a personal interest due to your work as Unison official. Great. Councillor Haller, I have that yourself is a contributor.
That's correct.
Fantastic. Councillor Williams, I have that yourself and your wife are both in receipt of a pension and contributors. Fab. And yourself, Chair, I have that your father and 2 other family members are in receipt of a pension and yourself are a contributor.
That's correct. Excellent. Thank you very much. Right, agenda item number 3, minutes of the Pensions Committee on the 11th of September 2023. So this was the last full meeting as opposed to the meeting we had in November. I think the minutes start on page 5 of the PDF pack. I'm not going to go through it line by line, but does anyone have any issues or comments they'd like to raise off the minutes? No? In which case, if people are happy, I'll take those as read, and people happy to agree them? Excellent, thank you very much. Item number 4, we've got minutes of the Special Pensions Committee meeting that we held on the 30th of November. That starts, in English at least, on page 17. Does anybody have any questions or comments off the back of those minutes? Any reflections on the meeting we had? No? Excellent. All right, I'll take those as read and agreed as well then. Moving on then, item number 5, and this is for information only. We have the draft minutes of the Pension Board meeting of the 25th of October 2023. These are also for noting only, although actually Ian, as you're here as chair of the board, is there anything particular from that meeting you'd like to raise?
Yeah, there's nothing else I want to draw your attention to.
Okay, excellent. Any questions from any of the members about these draft minutes? Excellent. That's that. Thank you very much. I'll take that as noted. Right, first substantive item on today's agenda then. We've got item number 6, Strategic Asset Allocation Review. Over to Alex.
Thanks, Chair. Morning, members, both on the screen and in person. And also we've now been joined by our advisors in the room as well, which is good timing considering the content of the report. So I think just in terms of, first and foremost, there's quite a detailed report here setting out all of the work and the consideration that's gone into the strategic review, which we've been reporting into the committee for pretty much all of this calendar year. I think before I start, there's just a couple of real summary points as to where we've got to, and then we'll work through the report. So, just as a reminder, that members have had updates in March and in June. in terms of the work that we would be carrying out as part of this review. Typically, the investment strategy, which the strategic allocation we're talking about today sits within, is reviewed following each of the triennial valuation exercises, which you'll recall took place in 2022. We've also, just to sort of frame this report, really, the work of the Wales Pension Partnership as the LGPS pool has progressed significantly since the last review, and so there's a big resource and support function around that can assist with this piece of work now. We've also progressed a lot of the responsible investment agenda, or progressing the responsible investment agenda, plenty to be done, but I think that also has been an opportunity as part of this review to think about how we might take that forward. And I think the final point is that we briefed the members in detail on the LGPS pooling consultation in September. This is a government-led consultation on future reform of the LGPS, and whilst at the moment that is just a consultation and there's been some announcements made, we yet to see any guidance that would set that out in terms of how we may proceed. But I think in lieu of that, we've considered potentially how the direction of travel might affect us as an individual fund, and how perhaps the strategic allocation may be positioned in such a way that we can address some of that in the longer term. Page 38, the recommendations, which we'll touch on at the end of the report, but they're there for information, really. And I think, unless there's any questions at this stage, I'll perhaps just work through the report. Chair?
Yeah, any questions on anything Alex has said? Chaps? Oh, Karen.
Okay, thanks very much. So, probably moving slightly ahead in the report to page 39. It's helpful when you're thinking about reviewing and updating the strategic allocation that you think about positioning in terms of how the fund has performed. The table on page 39 gives a snapshot of the return to the end of September this year, both for the fund and the benchmark, with the variance being whether we've over or underperformed that benchmark. And there's an active management aspect in which we're paying to achieve that in most cases. So that's quite pertinent. But I think the point I would draw to attention there is that over the longer term periods, and being mindful of how we fund these liabilities, performance has been reasonably strong, both at fund level, so the absolute return, but also relative to the benchmark over those longer term cycles, particularly 3, 5, 10 years and since inception. At the top of page 40, oh, sorry, there's a question.
Sorry, if I may, Chair. You refer to the fund here. You refer to this the Greater Gwent Fund, or is it the pooled fund with Welsh pensions? And secondly, is this in line with other pools in terms of comparisons, just to give a bit of a feel for where we are? Sorry.
So to the first point, yeah, for clarification, this is the Greater Gwent Pension Fund's return, so I should make that clear, but where we talk about fund-specific performance in this paper, it is the Greater Gwent Fund. In terms of how we benchmark against others, I think we're fairly comparable. There is a piece of analysis that's carried out each year which analyses the LGPS universe. Happy to share that after the meeting, because we've had the more recent, which will give you a bit of a feel for how others. There are also references in this report to how we fare in some of our positioning relative to other LGPS. Okay. So just moving through page 40, I think the point I would just draw on the table at the top here is essentially the allocation that was agreed in 2019 is on the right-hand side of the table. And the middle column there is where we sit as of the end of September. And you can see there's some areas where we're broadly in line, and there's others where there's quite noticeable discrepancy. And I think this report provides much more context explaining the reasons for that. I think the main two areas to draw attention to is in the equities. So overall, our equity exposure is quite significantly overweight. There are a couple of contributing factors to that. One, and this is considered potentially quite positive, is that the performance of equities across the last 3 years relative to other asset classes has been very strong, and I've made a reference to that in paragraph 6.4. The second is that one of the major decisions made in 2019 was to increase our private market alternatives, which you can see to the sort of bottom half of this table. And that's the area we remain quite underweight. And the reason being is that the establishment of those opportunities has taken longer than we'd anticipated. and also the build out and the exposure to those over time will take time. So that's the two predominant reasons for that overweight, underweight positioning. The other areas are broadly in line with what we would expect, say for a few growth plans.
Councillor Williams.
Sorry to come in again, but you mentioned a bit about it's taking time for the private market alternatives. Are there any particular, so for example, the requirement around accountability for what's the word? Sorry, I'm struggling to get my brain in gear here. Apologies. But is it a case that the equities are a bit more regulated, and therefore, if you like, movement is a bit easier, and it's harder to perhaps get the same level of assurance around the private investment types?
In some ways, I mean, so a lot of this is driven by the Wales Pension Partnership, and so through the pooling mechanism, we've obviously pooled a lot of our listed assets. The ability to develop those sub-funds and gain exposure to the markets is quicker than in the private market space, typically because there's liquidity and you can invest in those markets today. In the private market space, these asset classes have taken a lot longer to develop, in part because we collectively, with the other 7 funds in Wales, have tried to identify an opportunity that works for all. So that's a couple of years in the making. We've now got that in place, as has been reported over the last 12 months or so. And then on top of that, the time it takes to put that investment into practice is a lot slower than essentially an instant exposure to a listed market. So that's kind of some of the drivers behind the reason. It's not so much about the regulation, because the amount of due diligence that goes into establishing the sub-funds and the advice we take on what we invest in is consistent across the two. It's just the makeup of each of those investments that's slightly different. Actually, bottom of page, or the top of page 41 gives some context about where we are in the process of committing to private market alternatives. The intention of this is to show that actually we've committed quite a lot of capital in percentage terms, just over 18%. There's a snapshot of what the investment managers have called in the most recent quarter, and then an inception to date, so just under 3.3% of total AUM, meaning that we've still got a big proportion of that overall commitment to deploy. So that's trying to give a bit more context to the time that it will take to build this out. We supplemented some of the WPP, which is the bigger allocations, with some fund kind of do-it-yourself, which was a part of the recommendation that my predecessor took through the former committee, just so that we could make some progress in this space, recognising the time. Top page 42, I referenced PERC just now when I was talking about benchmarking the fund against the LGPS universe. This is intended to show a snapshot of where broadly the LGPS universe, so that's the orange bars, are allocated to each of those asset classes, versus where our fund, the Greater Gwent Pension Fund, is positioned at the end of September. If you actually plotted a third line here to show the strategic allocation that was agreed in 2019, we would be much more in line with the universe. It's just that positioning. Paragraph 6.6 is just there for information. It's to demonstrate the progress on pooling, given that the majority of our assets are now managed under the pool. As you can see from its formation in sort of early 2017-18 through to today, we're around 72% pooled, but that progress is slowing as we've dealt with a lot of the lower hanging fruit. We're now into the territory of having to find solutions that work where there are less economies, and that was one of the major drivers behind pooling, as you know.
David, yeah.
And I guess that reference is a bit about the collective agreement as well as to what is actually going to be beneficial for all funds within that, and that takes longer, doesn't it, when you try to do it in partnership? Yeah.
Yeah, I don't plan to dwell on the valuation space. This is section 7, page 42 into 43. I know we've reported on this several times over the last 12 or 18 months. The positive news is that the fund's overall funding level has improved quite significantly since 2019. The chart shows that trajectory, which is positive, but it doesn't come without its uncertainty and ongoing future risks. the makeup of the LGPS being an open scheme with liabilities linked to CPI and that uncertainty mean that one of the major outcomes of the valuation, although positive, was that investment return and risk seeking still need to be present in order for us to manage that funding gap and relieve the pressure on our scheme employers who are paying contributions. So again, that was one of the driving factors behind this review, is that there's a moderate increase in the investment return assumption from around 4% that was set in 2019 to 4.3% in 2022. And so when we think about how we position the scheme, we want to ensure that we still have a good balance of risk and diversification and exposure overseas to make sure that we've got a strong chance that we can deliver that return to support those wider priorities. Paragraph 8, midway down page 44, this is a bit of a technical piece of analysis that was undertaken. It comes with lots of caveats and assumptions, as a lot of this modelling does. What the intention and the purpose of it is to model really the various asset classes that the pension fund might be exposed to and how they would be positioned from a risk-return expectation. This modelling was done as part of using December 22 figures, so that's sort of before we had the heights of some of the inflation and the interest rate hiking cycle. But as you can see, the asset classes to the left-hand side are typically lower risk with the volatility measure, lower return. To the right-hand side, your higher risk, higher return. And obviously, if we were to take one position only, the fund would be highly exposed to volatility and risk, or maybe a lower expected return. And so we try to gain a blend of those asset classes that provide that risk and return benefits. I think really that brings us to where we are in terms of the key considerations for the review going forward. So hopefully the background has been helpful. I think moving to page 46 of the papers, this really starts to talk about some of the areas that we focused on specifically. Earlier in the report, and there's more information for members information really, that around equity, we've got a large equity exposure, broadly consistent with the rest of the LGPS, to be honest. What this shows on page 46 is a snapshot of performance of those equity assets. I mentioned that disproportionately they performed more strongly than other areas, which is why we've got that persistent overweight, or one of the reasons. You can see there that across all bar the emerging markets portfolio, strong absolute returns, and actually when you compare that performance to the benchmark, it's also very pleasing. And again, we predominantly are paying for active management of our assets, and so the managers are tasked, mandated to deliver that, and over those cycles we're pretty pleased over 3 years. I think really what we've typically a lot of strategies may just have a global approach. The approach of this pension fund has typically historically been to have exposure to various regions where there may be some diversification and some active management benefit. We see some of that in the numbers. I think an area that we've looked at quite closely is the UK. The UK listed equity market isn't, particularly the FTSE 100, is not a domestic market as such. There's lots of global companies that generate revenues overseas. And typically they are dominated, and there's lots of energy stocks, which is one of the areas that we've been looking at for a number of years related to the responsible investment agenda. And also, I think if we're just bringing in some of the more recent discussions we had on the LGPS pooling consultation and the push for UK growth capital, we see an opportunity potentially to, over time, and I should have stressed this actually at the start, that the proposals set out within this report are more likely to be a longer-term evolution. It's not something that, if agreed today, we would look to enact tomorrow. It likely would take us another 3 years, potentially slightly longer, to get to the longer-term position. But what we see with the UK market is potentially scope through our real asset allocation to the likes of UK infrastructure, real estate, and possibly some credit as well, that we may get a better exposure to the domestic UK market and support the UK growth capital, which is one of the driving factors behind the more recent consultation. The intention is that we invest within the UK market. So what we're proposing as part of this review is that we steadily trim some of our UK listed equity exposure, We think that will add the benefit as well of supporting some of our responsible investment and climate risk objectives whilst exploring the UK growth capital. And that's the substance of some of that discussion. The other area within equity space is the debate between a global and a passive and an active managed equity fund. So globally, we have exposure to both. Passive has typically a very low investment management fee and tracks a benchmark. Over the last 3 years, we've done quite a lot of work with BlackRock, who are the provider of the index, on behalf of Wales through a framework under pooling. We've done a lot of work to evolve the benchmark, and as you're aware, the former committee made a decision to move to a low-carbon passive mandate. So that screens a number of sectors and underlying companies who are particularly exposed to climate risk. That seems to have been a good initial step, but I think we recognise collectively that probably doesn't go far enough in the long term. However, I think on that point as well, as you can see on in the table on page 46, performance has been really strong on that mandate. And what we've seen is we're now roughly 25% of the overall Greater Gwent portfolio sits within this global passive mandate, which is quite large. And so what we've really considered as part of this review is whether or not we should look to gradually trim that exposure, or over time actually sort of around 10% reduction to more like 15% in favour of more global actively managed opportunities. And so we have a global mandate through the Wales pool. We're also in conversation with BlackRock as part of the pooling framework to provide an active solution as an alternative, but also as a complementary alternative where we can get a range of manager skill selection and use of data and technology really that can give some competitive advantage, I suppose, to the ability to select stocks. I think the final point I would add is that through the active management, we can better manage our responsibilities as a responsible investor, and we can work with the investment managers, as we have done with the Sustainable Active Equity Fund that's through the pool, is we can work to build a solution that does screen some of these sectors out from the outset. So we're helping to contribute towards the real world problem, I suppose.
Bessie, do you have your hand up?
Yeah, thanks. I just wanted to add, before you get too far off this more active BlackRock solution, it's actually based on what you see the line here, Europe. It's actually astounded me since 1999. This fund has been invested in a strategy which is active. It uses a lot of big data sources, and they've been really traveling with the whole development of big data, which is AI, but it's everything. And we've seen, as we've come to look at the strategy, which is actually not core to our SAA, and it wasn't core after 2019, we've still had it, and we've been looking at it and noting that it actually works. And so the whole idea is that, well, since Europe isn't a core allocation, maybe just they have a very big global strand of this strategy. So, to sort of take some of the base passive and put it into their global thing. But I just want to link it to a strategy and a way of going about things that we have been invested in since 1999, and it's delivering for Europe.
Yeah, thanks, Betty. I think that's helpful context as well. So I think the upshot of the equity review is determined to two things primarily. One is a gradual reduction in our exposure to the UK listed equity market, because we favour, through our real asset exposure over time, a better exposure to domestic UK, but also to reduce our passive global equity in favour of increasing our overall global active equity, for the reasons that we've just talked about, and that's one of the key recommendations of this change. Moving to the next asset class, really, that we've done quite a lot of work on is fixed income, thinking about how we may evolve that over time. I think the other thing that I would bring in here is that through our private market alternatives, we have exposure to credit or private credit, which is one of the areas that we've been building over the last couple of years. And so what we see is it's complementary really now to bring the private credit into the fixed income credit space, to give a more complementary exposure. And I think really what in the light of the sort of the mini budget last year, I guess, and the volatility that we've seen in fixed income markets, I guess we've really led to question whether or not these do provide traditional sort of global government bonds provide you with that that comfort that they are a good diversifier away from risk assets. And I think whilst we still believe they do have that role to play, there may be other ways that we can gain exposure to sort of duration and yield as well. And that could be coming through our unlisted markets, private markets over time. I'm not sure if there's anything that the advisors would comment on fixed income specifically in terms of, I'm referring to the middle of page 48, point 2 specifically around government bonds and investment grade credit.
Betty.
Yeah, I would just say over the past week I've been noticing more academic research and other commentators, not us, questioning this whole belief that, you know, fixed income, high-grade fixed income is a good sort of risk abater to equities. And in fact, there's some research just published in the US that basically really says it's not. This has been kind of like theology for decades, and it's now being questioned.
Just to follow up on that, I think that is partially because of the situation around inflation right now. Given the inflation is higher, it seems that the correlation breaks down when inflation gets over 3.5%. It's still perceived as a risk-off asset, so we can still expect some correlation benefits, but not perhaps as religiously as, or at least as steadily as in the past.
Yeah, thanks for that. So I think part of the output of that was, and again, supported really by the delivery of some of these assets, or all of the fixed income is coming via the Wales pool. And so what we're able to do, utilising the platform, is maybe sort of tactically reallocate to some of the other sub-funds available, which might give us a better blend of exposure there. And I think the detail is set out in paragraph 2, essentially looking at some of our real assets over time as having maybe a better opportunity with duration. So that in essence covers the fixed income evolution. I think if there's no further questions, I may move to multi-asset. So multi-asset is an area within our strategic allocation that we've utilised for a number of years. It is going through a period of change actually, and so part of this review has been quite timely as we maybe refresh some of our underlying assumptions of this asset class. But I think really what I would cover on page 49, a couple of points I'd make is that these strategies have exposure to all of the asset classes you see elsewhere in the portfolio within one mandate. And so you may wonder why we'd need to overlay that with a similar strategy on a small scale. I think what we would say is that the managers that manage these multi-asset products operate much more tactically than the pension committee could. As you're aware, you meet quarterly, we make decisions on the longer term, and so market activity during those periods, we're susceptible to some of the risks, and whilst we're thinking about long term, sometimes there's some challenges in the short term. But what the multi-asset managers are able to do is tactically trade during that period and reposition portfolios to try and preserve capital and manage that risk and the volatility. They're also very liquid solutions, so these are assets that we can sell down and redeem our cash on a short-term basis. And so as we move to a more challenging cash flow position over time, I think that's one opportunity we have. But we also see it as a good opportunity to fund some of our longer-term unlisted sort of private market asset classes, such as infrastructure and real estate. So there's a liquidity benefit to that. And I think in terms of the investment return expectations, this is something we've discussed with the advisors more recently. We did have 3 mandates up until a couple of months ago, and through various periods, they performed okay, but I think also there's been some genuinely disappointing performance, it's fair to say. And I think that the industry has recognised the challenges at the moment, and as reported previously, the Aberdeen product we have underwent a merger. We made a decision to come away from that merger in advance whilst we look at our long-term plans. And so we redeemed our investment there. And we have also another product through Invesco, which, again, the business has made a decision that this product doesn't resonate with clients in the same way, and so they are actually shutting that down. And so we will receive more of our proceeds. But actually what we've been doing over the last couple of months is talking to investment managers to understand what other products are available. We believe there will be solutions, and there may be something that the Wales Pension Partnership can do for us as well. And so we still see the multi-asset allocation playing a key role in the overall portfolio for those reasons. But I think this is one of the areas that, as we move into 2024, we'll have a more specific focus as we look at some practical solutions that can deliver on the allocation. I think the top of page 50 is real assets, and what we've tried to do here is almost evolve our definition of private market alternatives, because perhaps it isn't that obvious what that means. Real assets, we hope, resonates a little bit better in that usually the infrastructure and the real estate, those underlying assets are physical. You can see them and actually understand, what role they play. So that's part of our evolution of the way in which we're working here. No real significant change to the allocations that were agreed in 2019. I think we recognise we've got a long way to go to deliver. This is one of those areas that we've under-delivered, if you like, over the last 3 years. And so there's plenty of work to be done. I think we've obviously made some good progress on infrastructure, both on the DIY type. We've done a couple of investments ourselves, focusing on UK, British infrastructure, with some through the pool. Now we're having a more diversified, perhaps, with some overseas exposure, but predominantly we're focusing on investing in the UK growth. The final point I've made under infrastructure is that we see this as one area in particular where there's an opportunity to deliver on some of our responsible investor objectives. When we think about what net zero might look like, this is the necessary investment needed in the UK, we believe, to transition to net zero. And also there's the impact benefit. So this is beyond the strictly the climate benefits. There are potentially job creation and other advantages. So we can focus on some of the social aspects as well as the environmental, which are equally important. Real estate, this is an area that actually as a fund we've had exposure to for a long time, typically UK listed real estate. It's an area that although we continue to meet with the managers and maintain oversight of, we've not really looked to increase our exposure, and we've been waiting for the WPP to provide that long-term solution. The WPP actually have a tender out now for real estate providers, and in point D of the paper on page 50, you can see that broadly what the search that WPP have issued is looking for is one or more providers to deal with the UK listed, which is much of what we already have, a global property focus, which is something we don't have and perhaps will give us some diversification, and then the final strand is to look at impact investment, so thinking about how we can invest in real estate to deliver those wider benefits alongside a fiduciary duty, both in the UK and in Wales, ideally.
David.
Thank you. It was helpful to see this, because I recall from having attended a training module earlier this year that I think it was the investment in Manchester was talking about the resource and specialist skills that were needed in terms of investment into real estate. So it was obviously quite intensive and really quite difficult to do for an individual pool, an individual fund, and realistically probably more appropriate for a pool. I guess it's really just asking what the sort of time frame for that is, and the extent to which I guess will be kept up to speed with how that's progressing. That was the first question there. I suppose my second point was really, again, when we're looking at the kind of infrastructure and the opportunity to meet some of the climate risk objectives, are we confident enough, given that the pension pool is obviously looks long-term, moves relatively slowly, are we going to be able to move quickly enough, perhaps, if there are good opportunities for investment? So, for example, in hydrogen, battery storage, whatever it might be, that are sort of seen as infrastructure solutions for the UK going forward.
Yeah, thanks. I think two really good questions. On the timescales for the real estate tender, so as I say, that closes this month. and then there'll be a process where I will represent the Greater Gwent Fund's interests as we review the submissions alongside our advisors, and we essentially make appointments. So it may be that we appoint one provider for all 3 of those sleeves. It may be that we identify more than one that will be best in class really to provide those solutions. So I would hope that we'll certainly have a decision on who we appoint by the sort of early part of 2024, the spring, and then it'll be a case of working with those providers as how quickly we can actually identify solutions. And I think maybe the second comment I would make, both on the real estate and infrastructure, to cover your second question, is the reason we've gone down the route of appointing specialist managers is that they are probably best placed to identify opportunities, work with developers and work with investors to ensure we can put money to work and collectively benefit from the outcomes of that. And so I think, as opposed to if we were trying to do this either as a fund in isolation, or actually we don't have the skill set or the resources to be looking at these opportunities. And so the specialist investment managers is a way across these investment asset classes that we can deliver that.
Yeah, I mean, just to follow on from Alex, I mean, that's obviously part of the reason for the main reason for the pooling. But at the same time, if we go back to the decision we made in September to invest in the Crinbrook scheme, that actually was done at lightning speed with the advisors, Alex and Lewis, looking at that work. So actually, I'm confident enough that actually if the right opportunities do come across our table and there is any slowness in other parts of the system, shall I put it, that we have the expertise, and we've got the talent here to actually put that into practice if necessary. Talking of the talent, Betty, you have your hand up.
Now, I was just going to say I was going to say exactly what you were going to say, and in fact, there are opportunities because we've made some of these what we call DIY investments. We do have opportunities to do what's called co-investment, and this is covered a lot more in one of the subsequent papers. But just sort of, there will be investments maybe we could talk about in a few minutes.
Yes, I think my final reflection is, I mean, again, we're ranging further into the paper now, that actually some of the decisions have been taken before any of us were elected, but then also crucial, I think, as we've evolved our thinking in the last 18 months, have left us in a position where I think we've much greater flexibility going into 2024 than potentially we would have had coming into off the back of 2019, the last time the allocations were set. Alex.
Thanks. We are coming towards the end of this paper, I'm pleased to hear. Page 51, cash is the other sort of asset class we're talking about. Typically, we've only used cash as a kind of operational asset, I suppose. We don't typically view it as something that we're looking to generate investment returns from. I think in a very low interest rate environment, it's not proved beneficial to hold more cash than we need. And so we typically run, I think I've referenced in the report, underweight the 1% target that was agreed in 2019 by some way, actually, just to ensure that we can meet our obligations to pay pensions each month, which is the primary reason that we're here. Obviously, as we've moved into an interest rate hiking cycle, we've benefited in terms of our ability to generate some return on that. And I think what we found, and I took a report to the November special meeting about increasing some of the parameters and the flexibilities around how we manage our cash strategy, because we'd received a large sum of our investment returned, and we are due to have some more back in January. So that's given us more flexibility to maximise our returns. I think for context, we're generating something like £15,000 a day in interest on our current balance. So it's supportive of our cash flow needs. But I think what we are keen to do is redeploy that money in the new year into longer term opportunities. So I think what we're really proposing as part of this review is actually let's keep the flexibility around cash if we have any unforeseen situations in future where more investments are sort of sold down and cash returned. Whilst we look to redeploy, we can maximise the benefits through our cash strategy if and when needed.
David.
Yeah, no, just to say, I think that makes a lot of sense, and I would be very supportive of that.
Good.
Okay, I think really what I would say then from there's a reference to impact investment. We've touched on that already, and there's a paper later in the agenda, so I don't plan to cover that in any detail here. Page 52 shows basically what is being proposed as part of this review. As you can see, it's largely unchanged, although there's a lot of detail gone into the underlying detail, which the report sets out to show how we've evolved our thinking. In some ways, I think it should come as a reassurance that there isn't a substantial change, because broadly we're on the right track. And we've seen through the funding side of things that there has been steady progress over the last decade or so. So we hope that that will continue as a result of the work that's gone in. What we have tried to do, in recognising the earlier comments I made about fund positioning relative to the strategic allocation, we've tried to show how, sort of a glide path, I guess, how the work that we carry out, subject to this report being agreed in the next 3 years, might move us to the long-term target. The one thing that's probably certain here is that this won't accurately reflect what eventually materialises, but it's a best endeavour at this stage to just try and demonstrate how that evolution may be slower in some areas and faster in others, just based on market environment opportunities and the like. It'd be remiss of us not to reference responsible investment as part of the strategic review. Obviously, the fiduciary responsibility of the committee is to ensure we maximise the benefits from the resources we have, but equally the responsible investment agenda is something I know that the committee are very keen on. And so we don't believe that any proposals as part of this review would sort of contradict our efforts in that space. But clearly there'll be more work in the new year to review the policies around responsible investment, to just update some of that thinking and maybe even some of our commitments, which is something I know that the Responsible Investor Group are keen on too. I think the remainder of the report just covers off the conclusions, really. As I say, this work has been carried out in conjunction with our advisors, both around the table, but also our advisors across the Wales Partnership and our investment managers, who've helped to shape a lot of our thinking in terms of data they've provided, meetings and discussions we've had with them. I don't know, Ethan, is there anything just to sum up, whether there's any comments you'd make maybe with reference to page 54, just around the outcome of the review?
No, I didn't want to have my language interspersed with the review. It was really a substantial piece of work done by the team and Betty. So I really just wanted to provide an overview and contextual, I suppose, analysis at the end to say that this is very much in line with the direction of travel that we're seeing similar funds take. I think it's probably ahead of the curve in many respects, because that's the advantage sometimes of not having all that embedded exposure. We get to leapfrog some of the other detours that other funds would have taken. So in light of the inflationary environment, the interest rate trajectory, the experience of multi-asset and how that's shifting fundamentally, I'm very supportive of this, and also the staggered approach to getting there, I think, is key. We cannot do this overnight, but having a plan and constantly referring back to that plan, I think, is the way to keep us re-underwriting our decision on a regular basis.
Alfie.
Thanks. Just to say, I'm not in receipt of the pension. I'm not paying into either for interest. Sorry for coming in late as well. On cash, sorry for what I was going to say now. With the amount of cash we've got at the moment in the interest rates, if we're in a position when that lapses and the interest rates are still stagnant, obviously you'll touch on that later, but will we be looking to reinvest that in the same thing? And coming out of that, when interest rates fall again and we're looking to invest the cash, will it provide flexibility for these DIY investments, or will it go back into the strategic allocation, into equity or something like that?
Okay, Betty can answer that question.
Well, I think there may actually be some DIY investments, or follow-ons from things we've made, which might be coming sooner rather than later. And then part of this cash, that's sort of source number one, also to do some of this funding up, whether it's future drawdowns of the WPP, say infrastructure, private credit. They're just getting going, and then a bit later than that, probably real estate. So we're not looking to hold it there for longer, but because you can get 5% or even 4%, it certainly beats 0%.
Yeah, I think just to overlay that, really, we don't see cash as a long-term solution for investment. It's convenient now, given our circumstances, and whilst rates are higher, then there's an opportunity to take our time while we look. But essentially, we would look to redeploy this cash back into the market, into those long-term solutions, whether it's multi-asset and or private market real assets that we've talked about today.
So the holding of the cash is just sort of to add time rather than for the return of it, but the return is just an added bonus. And would you expect to get a higher rate if there was an opportunity that came up now when we have the cash available? You'd expect to get a higher rate than the interest rate available.
Back to you.
Well, it's hard to say on any investment by investment overall, because, you know, we'll talk about impact. Overall, though, certainly, but it's not necessarily the case that every single investment will be higher than cash.
Okay, Alex just said he's done, and if nothing else, he probably deserves a drink of water. So thank you very much for that. I know, Ethan, you've actually given your views. I'm just wondering, actually, Betty, as you're here, is there anything else you'd like to add, and any reflections on the strategy? I haven't asked them this, but also, as Ian, if there's any thoughts you've had, because obviously you're plugged into the system elsewhere.
No, I think there's more to say going in more specifics when we're in the private agenda, but I just want to say that I do know that some of these suggestions are a bit, I don't want to say out of step, but they're not all conventional wisdom. And there will be a lot of people say, oh no, you should have at least, you know, X% in fixed income. Why? Because people have always done it that way. So there is a certain amount of fresh thinking going in this. We might look different than other funds, but we know that.
Ian.
Thank you, Chair. Obviously, I've been involved in the discussions through the Responsible Investment Working Group. As Alex has just said, there's no major changes here from the current strategic asset allocation. And from what I've seen in other pension funds that I've got some involvement with, it's fairly much in line with what other funds are doing. So I'm very happy with it. I think it's the way forward.
Okay, in which case, if we move on to the recommendations on, just lost my page, on page 55 of the PDF, it's just an opportunity for members to ask any questions. I'm happy to take questions from the observers as well, if they're on the substance of what Alex has said. So David, you've already got your hand up. Carl, John, Alfie, if you want any questions, you can come in after David.
No further questions, Chair. Just to say thank you to the officers for a very comprehensive report and for everybody for dealing with the questions so thoroughly. So I would have no hesitation in supporting these recommendations.
That's very kind of you to clarify. Anybody else? Thoughts? Comments? In which case, Dave has gazumped my role in thanking the officers. I will underline that and say thank you very much for all the hard work. It's actually been... it's been quite interesting at the back end of this year having a greater understanding than I did this time last year to know what they're on about. So I think actually they have done a very good job, and I'm also quite I take heart from the fact from what Betty said, but also speaking to some others last week in Bournemouth and around about the place that actually we are potentially leading the pack in terms of funds of our size to be thinking slightly differently about where we're going to be in the next 3 years, and that's definitely to be applauded. Right, if nobody else has got any thoughts, comments, questions, I'll point everybody to the recommendations on page 55. So the recommendations are: 1, that we consider the contents of this report and approve the new strategic asset allocation as set out in section 9, and 2, request that officers undertake the following necessary steps, which include: A, notifying the Wales Pension Partnership, existing investment managers and other third parties as necessary, and B, at the appropriate time, preparing a detailed implementation report setting out how the fund might deliver on the interim allocation range with reference to the glide path. I've never said glide path in a meeting before. In which case then, members, are we happy to accept the recommendations on page 55? Excellent, that's everybody. Alex, glide path away. Thank you very much. Is it you again? You drink that water then. Right, item number 7. We have the Wales Pension Partnership update. Alex.
Thanks, Chair. Much more routine report, quarterly update, just setting out really the progress of the WPP. Throughout most of this year, actually, there's been a bit of a timing mismatch. So we actually had a JGC meeting on Wednesday, which would cover the period to to the end of the end of September. Sorry, so the Q3 update. This report covers much of Q2. I think I could just touch on some of the developments, really, with the papers they cover, just for information. So, last JGC in September, minutes of that meeting, or draft minutes of the meeting, in the appendix. The point I would make, and I've been reporting this throughout the last much of the year, the former Linked Fund Solutions, which is the operator for the WPP, were acquired by Waystone. That all went ahead as planned, and that they now operate under the Waystone brand, and so that's now underway. That's not reflected in this report, and I think it came through in the last quarter. But as of the next meeting, you'll have sight of that. I think on page 58 of the papers, there's a snapshot of, at the end of October, the exposure that the fund has to each of the funds. There is a typo in paragraph 5.3, just to confirm. Global credit should be 232 million, not what appears to be 2.3 billion at the moment. We'll make sure that's noted for correction. So the overall amount that is invested in the pool at the end of October was just under 2.7 billion, so around 72% of the fund's assets. I think probably, Chair, that there's nothing much more to say unless there's any questions on the appendices within that report.
Okay, thanks, Alex. Again, pretty routine, I think, update here on the activities of the WPP, but if members have any questions, please raise your hand. In which case, I'll draw your attention to paragraph 7 on page 59. So it's recommended the Pensions Committee note the contents of this report, as well as all the respective appendices. There's a catch-all at the end. I'll take it on board that we've all read the appendices. Everyone happy to accept this recommendation? Great, that's carried. Thank you very much. Now, Joanne, time to shine.
Quarterly performance first.
You've got Alex again first. I thought we were moving on. Right, item number 8 then is the quarterly investment performance report. So Alex and the advisors.
Thanks. So yeah, so I'll just cover the key points here and then pass to the advisors maybe to make some comments just to help the context. So this report covers the investment performance to the end of September, so Q3. Pretty flat quarter, to be honest, a slight positive return that you can see in paragraph 3.1. So slight improvement, around 6 million in cash terms to just over 3.8 billion. I think more pleasingly, what I would say is that longer term performance, as captured in 3.3, and it is typically the longer term that we're interested in and specifically focused on, is positive across all time frames and ahead of the benchmark. I may just pause there and invite Ethan perhaps to make some comments on the macro summary, which is in Appendix 1 of your papers, and then perhaps for Betty to make some specific comments on the Q3 fund performance specific.
Great, well, thank you. Well, I'm sorry that I almost our star of the show was always taken away there with that segment being skipped over. So this is typically a quarterly report, but I thought given we're close to the end of the year, and it's been quite an interesting year, it would be good to look back 12 months ago at what sort of environment we were facing then, because I think it's hard to believe it was only a year ago that things look completely upside down versus where they are today. And I'll tell you how exactly, in terms of why I say that. And also reminding ourselves, A, how quickly things can change and kind of do a U-turn like that. But B, also casting our mind back, life was still going on back then too, when in relative terms we were probably in the doldrums. So I think it's just almost important to remember that disconnect sometimes between what the media headlines say and what the data says and how consumers feel, because we are having a bit of a disconnect like that again, but maybe in the other way. So looking back a year ago, where were we? We were looking at markets being down about 20 or 30% for the year. We were getting used to very frequent rate hikes, one of which had been 75 basis points here. We'd had more of that in the US. That was now becoming normalized. High rates of inflation were becoming normalized. We were speaking about 10% COLAs back a year ago. We were still reeling here in the UK from the effects on the mini budget and the bond crisis, the gilt yields blowing out. And there was a great sense of uncertainty, a great sense that many pension funds, not LGPS, but other DB plans, were essentially much reduced and in a precarious state, and it was unclear who exactly was buying into the UK equity or bond market. It certainly wasn't the institutional interest there might have been before. As I mentioned that global markets were down, sterling and FTSE markets were actually somewhat flat. Then compare that, we'd also just had, we'd about 10 months into the Russian invasion of Ukraine, and it seemed to be weathering the storm somewhat well in terms of in heating prices and the inflation there. A year later, it was almost a complete mirror image of that. We have the situation of markets being up 20 or 30%. I'd also like to say a year ago, nobody had ever really heard of ChatGPT, or they were just about to hear about it. So that's, again, a sign of how much everything can change in 12 months. Interestingly, FTSE markets are again somewhat flat. So there's a mirror image there, but just not showing the same extreme variation. Interesting that very little has changed. Inflation seems to be in retreat. We've seen quite evidence confirming that around the world. Many of the dislocations from the COVID supply chains have been generally ironed out. And we've managed to keep inflation with energy under control. And for the most part, that seems to be coming down the mountain now with respect to inflation, not going up. By the same token, the need to raise rates seems to have changed. We now seem to have a pause around the world in terms of interest rate hikes, a suggestion the next rate hike will be downwards, or the rate move will be downwards, and a sense that all the central banks are very data dependent. The other important change versus a year ago is we've never had that recession that everybody was forecasting. A few quarters ago, I made the comment that this was such a widely anticipated recession that even contrarians who'd always, the stop clock that had always called for a recession, were now saying that it was likely not to happen. It was simply too much baked in, and they actually were the contrarians that proved to be right. Then when it comes to the geopolitics, we're still dealing with the situation in Ukraine. We're also dealing with the situation in the Middle East. That has not translated into spikes in the oil price, however, but it is a reminder of how much we can actually miss in terms of perhaps the intelligence missed this surprise attack on October 7th. And it's quite analog means did seem to defeat almost our digital prowess in that respect. So another reminder that we still have the propensity to be surprised, and but ultimately markets seem to take that in their stride. So just where we are today and the backdrop, this has been a very strong market for equities. That's been good for your portfolio. The negative side has been the strength of sterling. Normally that's a good thing, but when you own assets outside sterling in dollars and euro, and sterling strengthens, that will shave off some of the return there. You've had that happen in opposite ways many years in the past, but now it's kind of that returning to the mean. We talked about the UK economy being somewhat stuck in the mud before. Certainly the FTSE would reflect that. There's a sense that that's also returning to life a little bit. We're seeing growth where we didn't think there would be any, and that's it. And we haven't seen the consumer collapse under the weight of mortgage rates and inflation. Although there is a sign that not every consumer clearly is experiencing this environment the same way. My inflation is not the same as your inflation. I think we have to see that there's probably this K-shaped recovery that is still happening when you look at consumers. But whether the consumer remains robust will clearly be the key factor. Jobs remain somewhat robust, certainly for this stage of the cycle. That is probably what's propping up the economy, because as long as there are jobs, there's generally a strong consumer. And that's been another reason why the recession has never materialized. And as far as otherwise, we're certainly seeing that this is more of a global phenomenon, that we do have the strong employment picture, the strong consumer, a lot of wondering how long that's going to last. But for the most part, we are in relatively strong economic shape. Tech has clearly been the flavor of the year. We've seen the Magnificent Seven, which have dominated global stock markets. The US stock markets have therefore also dominated global stock markets. You have exposure there, that's been good, but you also have exposure in other segments of the stock market that haven't done particularly well. We would expect, I expect that there will be more of a balancing out in equity markets. What we can see is that corporates are doing quite well because the consumer is doing well. Because of that, earnings have been strong. They've generally surprised on the upside. That has led to, it's been well received, and it's led to more fuel to the positive equity markets. So again, getting to your equity market discussion we just had earlier, very comfortable with a large position in equities. It's appropriate that it comes down, but equally active, given the quite the dispersion that we're seeing in equities, active is a good place to be. Fixed income, we mentioned interest rates are likely to be now flat or going down. And for that part, we will probably see an end to the kind of the heyday in cash, but not necessarily anytime soon. There's a sense that this higher for longer environment may not actually be as high and as for as long, but that has only really changed in the last few months. It's been you mentioned the performance for the quarter. It has been quite a varied quarter. We've had some negative September and October, followed by extremely strong performance in November. All of that extremely strong performance came from a sense that the central banks were now done, that they're done with their rates, that there was a slow puncture, perhaps, in terms of the economy, as opposed to a tire blowout. And certainly that's the phrase that was used in connection with the home prices here in the UK, more of a slow puncture as opposed to anything kind of sudden. So I put a few things in here. I tried to have a spotlight, natural capital. This is for you to read, perhaps more than for me to talk about, but there's just an indication that we've been very much a kind of tale of two cities for the sustainable universe in the last year. As there has been a focus on energy security, there has been less focus on ESG. There's been headwinds around that. So sustainable projects have faced headwinds, metaphorically, because of the interest rate environment. So some of those business plans, let's say the wind farms were constructed based on, or the solar panels, may no longer be as valid once interest rates rise and the financing cannot be sustained. So there will be a winnowing out of some also-rans in this division, and there's probably likely to be a bit of a challenging time for sustainable infrastructure going forward. Long term, it has absolutely a place, but just with the current environment, and as well as some cheaper, say, natural gas, for example, there are competitors there for it, and a little bit of headwinds around ESG and sustainability in the US primarily just could lead to a checkered future for that in the near term. However, the focus, the COP28 is still going on. The focus on the natural capital, biodiversity, the need for long-term solutions to get to net zero, that has not gone away. Again, winnowing out a strengthening of providers in that respect. It's likely to be long-term positive for your portfolio and your sustainability targets. What are we looking to now as the year comes to an end? Clearly, we're wondering whether this recession has been kicked into infinity, and we will sort of muddle through with the consumer doing okay, but not feeling great, but perhaps doing okay. That seems to be the consensus we're seeing now. We know that the central banks have more in their tank to stimulate the economy should they have to. That's the good thing about these rate hikes, the 14 or so here, 11 or so in the US, that we now have a lot of ammunition to actually ease, because there's probably not a lot of ammunition on the fiscal side. Very few, whether in the US or here, very few governments have the ability to make tax cuts. We saw what happened here a year ago when that was tried. So there probably has to be stimulus coming from another side. I'm going to wonder whether the AI revolution is in fact just that, or whether that's likely to be a bit of a hype cycle. Very close watching of that, focus on the Magnificent Seven and whether that can be sustained. And again, getting back to geopolitics, as I mentioned, it's not really affecting markets, but it still is dominating headlines. And we need to know whether geopolitics, I suppose, are likely to present more surprises or not. So that is the context to the performance that has just been summarised. Move to the next section or take questions.
Okay, thank you, Ethan. That was really interesting. Alfie, was your hand up? Yes, Alfie.
With the Magnificent Seven, just a question of how big investors really make their moves. With them doing so well at the moment, is it likely that they'd move their money into bleeding over sectors such as healthcare, etc., or are they likely to focus more of their money into the tech stocks?
Yeah, that's a really billion-dollar question there. I think one of the issues we've been looking at yes, probably more than a billion, is around the muscle memory of investors, and that's momentum. I don't have the stats here, but I was at a presentation recently. The holding period of stocks is much shorter today than it was, say, 20 years ago. So the cycles are moving more quickly. Investors are reacting more quickly. They've about $7 trillion in money market funds. So that's dry powder where they can move in and out quite readily. The muscle memory is people have always made money in big tech stocks, even though they were quite volatile in 22. There's a sense that we'll always make money, don't bet against tech. It's perceived as a safety trade now. Don't get fired for buying Meta, for buying Google, buying Nvidia. Therefore, there's a sense that this is perhaps has changed for, style in terms of it's not a high growth sector. These stocks also haven't really moved around with interest rates as they would have thought they would. However, we would think that there will be an evening out simply because the dislocations in other sectors like utilities, healthcare are just too large. So I would not bet against tech stocks, but I would also not want to be fully concentrated there.
Thank you. John.
As we're on geopolitical matters, I saw that on page 92, I think it was, that we mentioned the fact that the Palestinian and Israel war hadn't affected oil prices all that much. There had been much divestment of stock. I see that quite a few of the larger players have decided to cash in their stock on, for example, Israeli banks. I know that there's an economic activity of public bodies bill in 2022-23 being discussed, and I was wondering if that would impinge on anything that we're invested in. Thank you.
It's a very good question. Just in terms of oil price, the reason there's been a surprise that the oil price has not been higher, it's really a demand-supply equation that supply has been so robust and demand has been in question as this recession kind of rumour percolated through markets. So that's really been the story. As in terms of divestment, I think that for other clients we've looked through the portfolio percentage-wise. There has been very little exposure to Israel. I presume that's something that you have also done. I haven't been privy to that. So,
yeah. Alex, do you want to finish up that?
Yeah, sure. I think to Ethan's comments, we've had some. So our exposure to there is a small exposure to Israel, which is typically through the WPP products. As I say, majority of our actively managed listed assets are through Wales now. We've had some analysis done which suggests it is a very, very small percentage of direct exposure to the region. There are some sort of the secondary or the wider exposure to the likes of Israeli banks, which again is quite small. I think what we are in discussions, and we're in the process of preparing a response actually to some of these external concerns of exposure, is looking at what our engagement efforts can do in terms of whether or not there is any scope to work with the underlying corporates in these regions or who have exposure to those regions. And where we can't, then we need to think about next steps. I may not just sort of preempt what that exactly looks like, that response, but I'd be happy to share it with all members once it's been made available.
Is that okay, John?
That's great, thank you.
Excellent, thank you. Anyone else? David.
In relation to are we starting to see the impact of investment in terms of the diversification of some of the big oil and gas giants into sort of alternative energy sources? Some of them are starting to extol a bit of that, but how realistic that is and how much investment is actually shaping some of that, be helpful to get your opinion.
Yes, certainly there's a laser focus on the engagement aspect, and when whether this commitment to a transition is a high conviction commitment or is a kind of a token gesture, and that certainly seems to be is under scrutiny now by our engagement partner, because that we need to see that there's a viable plan in place, that it's a reasonable commitment. I'd say this is somewhat muddied by the political environment in the US right now, where there is not reward for this, but actually a penalty of some kind for sporting ESG in open fashion. And I think it's unfortunate of a weaponization of this term. So I'd say that we can see that there has been some evidence of pulling back by some of the large fossil fuel companies from their commitment. It was never a very meaningful commitment in the first place in many cases. It was a beginning, it was a first step, and it was always intended to be longer dated. I think I'm getting confidence from the COP28 rhetoric that we all have our eyes on the same medium-term objectives. Just that in the near term there has been, as I said, the energy security and pricing concern, which erupted around Russia-Ukraine, did momentarily derail that longer-term objective, but not in the medium term.
David again.
Yeah, and the second bit, I guess, is obviously the situation in Gaza kind of erupted out of the blue a little bit. I think people have probably taken their eye off the ball in the Middle East, but I would suggest that there's greater volatility to come, and I think the next pressure point is probably going to be Iran and Iraq. So.
Yeah, it's interesting. I went to a presentation given by Ian Bremer from this, who's a geopolitical analyst, and his view was that this would get worse before it gets better in the Middle East, but not that Iran would not end up intertwined in the conflict, and that would be the factor that would push oil to the $150 a barrel limit. But for now, it was a dance that has been executed quite delicately in some cases, but that is that would be the outlier condition.
Okay, thanks, Ethan. Thanks, David. Any other questions on what's been discussed so far? Is that no? No, fine. Back to Alex then, unless Betty, is there anything you'd like to add? No.
I think much of the remainder of this report, the cover report, actually just provides more context. It's there for background reading. I think we've covered a lot of the themes through the prior update anyway, so there's not too much to add there. Maybe just as ever, we include the current allocation on page 86, some other charts just to show where we are. And then in paragraph 8 on page 88 is an update on the current quarter. As I said, it's too early to have the performance numbers. That will now be available in January, so you'll have sight of those in March. But I think maybe a disappointing month, October, but November was much stronger. So overall, we're hoping that if the remainder of December continues on that trajectory, we could have another positive quarter to be reporting in the new year. I think that's it from me, though, Chair.
Okie dokie. I've got no questions or further comments, so unless anybody else has anything else they'd like to add. Page 88, then, no, that's the conclusion. Page 89 of the recommendations, it's recommended that members note the investment performance has taken place during quarter 3 of 2023. Everyone happy to note the investment? Okay, excellent. Thank you very much. Now, in her rightful place, it is item 9, Joanne.
Thank you, Chair. Just a couple of updates from the administration side. With regards to My Pensions Online, the fund now has just over 30% of the total membership registered on My Pensions Online. That's important for interaction with members and the fund. In December, we'll be sending out our newsletters to our pensioners, and each year now we are sending these out online to members who are registered for My Pensions Online, and then in post for people who aren't. So that percentage will help the fund continue the communications, but also enable us to move more towards electronic communications going forward. During last Pensions Committee, I mentioned about Pensions Awareness Week. And during the month of September, we actually held a Pension Awareness Day with Torfaen County Borough Council. So it was just an update on that. It was very well supported, with over 80 pre-bookable appointments made before the day. And we also held a number of drop-in sessions on the day. And we received an overwhelming positive feedback from the members who did attend. And we were in a position we had to turn some people away because there was so much interest in the sessions. So we did follow up with those members and arrange separate sessions with them. But we've also been asked to arrange another session in the new year for Torfaen County Borough Council. But also we'll be expanding this and offering pension awareness days to our other employers, going out and carrying out sessions with their members. So it is very positive, and it's something that we want to continue and grow in future years. Just moving on then to touch on cybersecurity. So in December, we'll be holding our annual cyber tabletop exercise with Hayward Pension Technologies. Cyber security, as you're all aware, is very important, especially within the pensions environment. So we'll be running through a scenario with Hayward Pensions Technologies to see how they react if there was a cyber attack. And I'll be running through that with our Chief Information Security Officer. This will be the third year that we've carried this out, so I think it's a very important process that we do. And the final part in this report discusses McLeod. So on the 1st of October, the McLeod regulations were laid, and this brings into effect the McLeod remedy. This is backdated to the 1st of April 2014. So over the past few months, we have been testing the system. Our pension administration system has been upgraded to take into consideration the McLeod changes. We've been testing this. We've had a new release in December, which rectified some fixes that we needed to carry out the McLeod calculations. So we're hoping to switch on McLeod now in the new year, and that will mean that we'll be processing business as usual cases. People who are going onto pensions, etc. And then we'll be looking then at doing rectifications for members who have already gone onto pension and checking and amending any payments if need be after that. We're also this month going to be sending out disclosure letters. So these need to be sent to all active, deferred and pensioner members to tell them about the regulation changes. The information needs to be given to them by the 31st of December, as we have 3 months to notify them once the regulations came into force. So letters will be going out to our active and deferred members, and we're including information in the Gwent Grapevine pension newsletter in December. So that was the administration update. If anyone has any questions.
Okay, thanks, Joanne. I've got 2 questions, actually, but I'll take them from on the table first. I've got Carl, as he's thus far been Trappist. I think Ethan, David, anything from you? Oh, Alfie, then full house, almost. John, anything? No? All right, not full house. Right, I'll take Carl, Ethan, Alfie, David.
For the record, Chair, it's not a Trappist vow. It's just I only speak when I need to know something. But I do take everything in. Thank you, Joanne, for that. That was really useful. I want to focus particularly on the sort of My Pension Online thing. Want to know a bit more about the comms, so people being able to sign up for that, because I know we're sort of about 30% of our members in there. Really welcome the fact you've held sort of roadshows, if you like, pension roadshows in Torfaen Borough Council. And note that you said they'd be rolled out to potentially other local authorities. Would we host those in terms of our staff going into other authorities and sort of answering questions? And what are we doing about sort of our admitted bodies, so the non-council employees, about getting the message out about pensions online for them? And I'd be interested to know, if you have the figures, what of the sort of people who are signed up for My Pension Online, what percentage are local authority and what admitted bodies, and whether that messaging is getting to where we need it to go. Thank you.
Do you want to take them one by one?
Yes, yeah. So to begin, we will be offering pension awareness days to all our other employers. We started off with Torfaen because this is the first year that we've actually started doing this. And what we will be doing is going out to the sites and getting them to arrange a room, and then we can host the sessions then in the different organisations. So that'll be open to the local authorities, but also all our 57 employers will offer that. It'll have to be run over a number of weeks if they all decide to take up that offer. But yes, it'll definitely be rolled out to everybody going forward. With regards to My Pensions Online, we're keen to increase the membership as much as possible. I don't have a breakdown at the moment of the number of local authorities compared to the other admitted bodies, but I think I can get that information quite easily, so I could follow that up after the meeting. But yes, we're keen to increase the number of people signed up, and we do try and encourage people every time we send out the annual benefit statements in August. We send a letter telling members they've got to register for My Pensions Online to actually get access to it. So that way, each year, we do see an increase in the months of August and September of the number of members signed up to My Pensions Online.
Is that okay, Tom? I think before I bring Ethan in, it's just a suggestion. So tomorrow, Alex and I got an engagement meeting with a number of the leaders and senior officers of the other authorities in Gwent to talk about the new the investment strategy and the impact policy. Would it be helpful, actually, if we raised it at that level, that actually we're willing to go out and do these roadshows? I think it'd be quite good for us to be actively sort of almost forcing some of the other authorities to take this up, because I think Carl's right. We need to be as on the front foot with this as possible. So I'll try and remember to do that tomorrow. Ethan.
Just a very short question, because I'm curious. The one-on-one meetings, was there any kind of theme that came up there? You said they were well received. Was it ease? Was it the My Pensions Online? Just anything, just in a nutshell, that came up?
Yes, we did think maybe it would be, the majority of people would be asking about retiring and those type of questions and wanting to know an estimate. And although we did have questions like that, there was a mix of information that members wanted. So it was My Pensions Online, ABCs, taking out additional voluntary contributions, explaining annual benefits to members. So there was quite a varied amount of questions that members came to us with. So yes, it was quite interesting.
I think with the inflationary environment, clearly the pension becomes more and more in focus. I'm just curious.
Thank you very much. Alfie.
Thank you. There's a greater increase in pensioners joining than people paying into it. Is that because they get to withdrawing their pension and then they want to see how much they've got and things like that? And is there greater utility for people withdrawing their pension than people paying into it on the software? And then when joining the pension fund, are people encouraged to join My Pensions Online? And is there a greater amount of people coming into it through joining the pension fund as a proportion? Like, so say 50% of people who join the fund go onto My Pensions Online compared to the amount we've currently got on there. Is there a cost associated with greater enrolment to the provider of the software? And then just with the pension awareness sessions, were the majority of people coming in people who were already quite involved in their pension and wanted to know more, or was it people who didn't have any awareness of it, and then we got sign-ups to My Pensions Online through that? That's all right. So we'll take them one go. Cheers.
Okay, you're right. There's like 4 in 1. And you have to answer them. You have to answer them in the correct order that they were asked. Yeah.
The order, but okay, so what we started for the past number of years is when people join the scheme, we automatically try to get them set up on My Pensions Online. So we send them at their starter pack, but we also say if you want, you need to log on to My Pensions Online to access more information. So I think that has started, that has increased the number of members starting when they first join the fund. We've also then changed our processes. For example, our deferred processes. We direct people to My Pensions Online when they leave the scheme, so we encourage them to sign up at that stage if they haven't already signed up. And also we've got things that we want to do going forward when people retire as well. We want to try and encourage them to do the retirement process through My Pensions Online as well, once we get increasing the membership. That's an aspiration that we're working towards. With regards to the Pension Awareness Day, we had members coming to us asking how to sign up to My Pensions Online. and then we go through the process with them. So I think it was more that they came to the fund on that day to find out some information about their pension, and then we encouraged them at the same time then to sign up to My Pensions Online and get on board, so trying to engage with the members when we saw them at that time. And then you mentioned something about a cost, didn't you, sorry, for the My Pensions Online system, was that right?
So, obviously, I'm not sure how it works. Do we pay for the system? Obviously, it's not in-house, I assume, but we pay for the system. Do we pay per person that signs up then, an amount?
So is the question that what cost do we carry? Is there some ratio between where we're out of pocket, the more successful we are in getting people to sign up to the system?
Yeah.
Yeah.
Yeah, so it is based on a tier system. So it's not necessarily based on the number of members signed up. We provide the number of active, deferred and pensioner members that we've got, and then we pay for the system based on the total number of those. So it doesn't matter if more sign up or not, it would be the same amount unless the total membership of the fund changed and went increased or decreased.
Maybe just one point, because you mentioned about functionality or in terms of is it that pensioners get to receipt of their pension and use the system? So I don't think we envisage this. The system is intended to be able to update your personal information, nominations, which in turn helps the fund and know where people are. But what it's not supposed to do is provide advice specifically. What we would still encourage is all members who are approaching retirement to call the service so you can have an indication of what your benefits may look like. And then there's a slide and scale tool. But actually, I think Joe's team would encourage all members to contact so that they get the right advice and it's not completely led by a system.
So I guess the final analysis is we pay for everybody. We pay for the figure of everybody who's got a pension with us anyway, which actually should act as an incentive for us to get as many people signed up to the scheme because we're paying for them anyway. Yeah. David.
Chair, I think my points have been covered by the previous two.
Excellent. Mine hasn't. So I've got a question. I've got a question about going back to McLeod. Have we done estimations for how many people are likely to be affected by the recalculation?
We did some estimates quite a while ago. I haven't got those figures with me at the moment, but we are expecting the numbers to be very, very low, really, in the grand scheme of the number of members that we've got in the fund who are going to be affected by it. But when we go through this process now, we'll be able to see more clearly. But I think overall it's going to be a small percentage affected.
Which is good, I guess, but an awful lot of work will have got us to that place to actually not have that many affected. God bless the department. This one other thing item here I'd just like to raise, because there's nowhere else on the agenda to raise it. So I've become the chair of the LGA's Local Government Pension Committee, and I took over the chair of that last week. So that is the one body that meets nationally with representatives from England and Wales, from Scotland and from Northern Ireland. And Joanne is on the technical working groups of this. One of the issues we brought up here previously is about compliance of the pension fund with Sharia law. I think we discussed it last meeting, didn't we? And it's just some feedback to say that actually this has now been taken to the Islamic scholar that is kept on retainer by the LGA for such purposes, and the scholar has decided that actually, as pensions are a deferred income, it is compliant. So we're just waiting for that. We're waiting for that to be finalised and made official before we can come back. Because I know actually, from a serious point of view, there are a number of employers within the scheme who've got growing concerns about this because their members of their workforce are threatening to leave the scheme because of the lack of compliance. David.
Perhaps we should pass on our congratulations to you, Nathan, for that appointment.
You haven't been to a meeting of it, so maybe you should observe it first before you think congratulations are in order. But thank you very much. Okay, if nobody else has any issues to raise on page 125, paragraph number 8, the recommendation is that we note the contents of this report. And thank you very much, Joanne, for all your hard work. And also, it was remiss of me, I think I never remember to mention her because she's normally online, is to say thank you to Felisa for all her hard work on the previous report. And because you've normally got your camera off, Lisa, I always forget to say thank you. But thank you very much for being nice to everyone today. Item number 10, we have the risk register update. Alex.
Thanks, Chair. A short update today because this has gone through the usual governance process. The board considered at their meeting in October no changes to the actual register itself on this occasion, although I think what's been recognised is a number of the risks in the report reflect on the investment strategy and the strategic allocation, and so on the basis of today's discussion, we'll go back through and review some of those risks, and we'll work with the board, as we have done over the last couple of years, to help inform that. So nothing substantial to update today, but just to note that we'll be going through that process in the new year, and we'll report a more detailed update probably in March.
Okay, thank you very much. Is everyone happy with that, or is there anything specifically they'd like to raise looking at the register? No, in which case then we'll take that as noted as a recommendation for recommendation on page 128 to paragraph 5. So the recommendation has been note the updated risk register. Happy with that? Yeah. I'll take that as a yes. Thank you very much. Item number 11. Back to Joanne. This is elected member training.
Thank you, Chair. This is just a very short report as well, just setting out members' training log for 23-24 in the appendix, and the annual training programme in Appendix 2. And in the new year, we will bring back the annual training programme for 24-25.
Okay, thank you very much. Any questions, any thoughts on this, David?
No, it's just do we need to notify you if we've completed some of the things? Because I know I've done some of the pension fundamentals sessions, but not all of them, I'm afraid, because other things got in the way.
If the training is arranged by ourselves, then we do update the log. But if you do want to let me know about the fundamentals, if you couldn't make them all, I can just update it accordingly for that.
Anything else? In which case, recommendation on page 135 is that we note the training update and we've commented where appropriate. So everyone's happy with that? John? Yeah, excellent. That's that. Right. Item number 12 is the date of the next meeting. It's the 18th of March 2024. That's for noting only. Seems like a long time ago, long way away. It'll come quite quickly, I'm sure. Right, agenda item number 13 is the exclusion of the press and public. Right, so this is to agree the exclusion of the press and public from the meeting as presentations and meeting papers are not for publication because in accordance with paragraphs 12 and 14 of Part 4 of Schedule 12A of the Local Government Act 1972, as amended by the Access to Information Variation Order Wales of 2007. It contains information about a particular individual and information relating to the financial and business affairs of particular persons, including the Council, and in all the circumstances of the case, the public interest in maintaining the exemptions outweighs the public interest in disclosing the information. So, members, are you happy to agree to the exclusion of press and public from now on? I'm happy to allow the members of the pension board to stay for the remainder of the meeting if people are happy to go along with that. And before we turn the cameras off, to all our fans out there watching on the cast, I'd like to wish you all a very Merry Christmas, and we'll see you in the new year. And now you can turn it off.